Global markets took a sharp turn on Tuesday as investors grew increasingly cautious, sending stocks lower while safe haven assets like gold and government bonds surged. The tension stems from mounting U.S.-China trade concerns, just weeks ahead of a high-stakes summit scheduled for October 31st in South Korea, where President Donald Trump is set to meet Chinese President Xi Jinping. Earlier optimism from Monday's rally faded as Treasury Secretary Scott Bessent's comments added fuel to the uncertainty. Bessent accused Beijing of attempting to harm the global economy, which spurred risk-off sentiment in markets. Stocks in Europe fell 0.7%, tech shares in Asia were pressured, and U.S. futures for the S&P 500 and NASDAQ suggested that Monday's gains might not hold, leaving investors wary about the near-term outlook. Investors are clearly walking a fine line, trying to interpret whether recent U.S.-China actions signal escalation or negotiation. Both nations began charging port fees on ocean shipping firms, affecting everything from toys to crude oil. Mark Velan, head of investments at Lucerne Asset Management in Singapore, described this move as a classic escalate to de-escalate strategy, posturing ahead of the summit without necessarily triggering a full-blown trade war. While some analysts caution that these measures increase uncertainty, others, like Investec's chief economist Philip Shaw, argue that recent sell-offs are more of a market correction after a strong rally than a signal of deepening panic. Traders are adjusting portfolios to reflect cautious optimism, balancing exposure to riskier assets with a flight to safety, knowing that headlines in the coming weeks could swing sentiment dramatically. Monday had offered a brief reprieve for markets, with Wall Street's major indexes climbing as much as 2.2%, led by chipmakers, after President Trump struck a relatively conciliatory tone on trade. This eased some of the panic from the previous week, when his announcement of 100% tariffs on Chinese goods had sent shockwaves through global markets. Yet by Tuesday, investor anxiety returned, highlighting how fragile sentiment remains. Safe haven assets like gold reacted strongly, reversing overnight losses to climb 0.7% to $4,140 an ounce, nearing Tuesday's intraday record of $4,179.48. Meanwhile, riskier assets such as Bitcoin fell 3.5%, reflecting the tendency of digital currencies to move alongside equities in times of market stress. Currency markets mirrored the cautious mood, with the US dollar strengthening against the pound and Australian dollar, while the yen, a traditional safe haven, also edged higher. Bond markets have also reflected the shift in investor sentiment, as yields on U.S. Treasuries fell. The 10-year Treasury yield dropped 3 basis points to 4.02%, while the 2-year yield, more sensitive to expectations of U.S. interest rate changes, fell 4.6 basis points to 3.48%. Its largest 2-day drop since early August. Analysts note that any escalation in the trade dispute could push the Federal Reserve to act more aggressively with rate cuts to stabilize markets. Investors are closely watching upcoming economic data and Fed signals, trying to gauge how monetary policy may evolve amid slowing global growth. Meanwhile, oil markets showed weakness, with Brent crude falling 1.7% to $62.63 per barrel after OPEC's report indicated that next year's global supply is expected to roughly match demand, reducing fears of shortages and adding another layer of uncertainty to risk assets. Amid these market shifts, traders are trying to interpret the larger geopolitical context. U.S.-China trade tensions are at the forefront, with both countries strategically positioning themselves ahead of the late October summit. While some measures, like port fees, might appear aggressive, many experts see them as negotiation tools rather than a full-blown conflict trigger. Philip Shaw of Investec pointed out that, historically, these maneuvers often precede discussions rather than escalate hostilities. Still, the uncertainty has global investors reevaluating portfolios, moving away from riskier equities and towards safe haven assets like gold and government bonds. The combination of mixed signals, upcoming trade talks, and fluctuating investor confidence is creating a volatile environment where market reactions can swing sharply within a single trading session. Currency markets have further highlighted the risk-off sentiment gripping investors. The US dollar gained against traditionally stronger currencies during bullish periods, including the British pound and Australian dollar, which fell 0.5% and 0.9% respectively. The Japanese yen, often seen as a safe haven, strengthened slightly to 152.04 against the dollar after Japan's finance minister stressed the need for policies addressing inflation rather than deflation. These moves reflect how investors are hedging against potential disruptions in trade and global growth. At the same time, equity markets continue to fluctuate, with European stocks retreating from record highs and Asian tech shares under pressure. Traders are caught in a balancing act, monitoring news from trade talks, global economic indicators, and corporate earnings, while weighing safe haven assets against equities for short-term gains. Investors are also keeping a close eye on Federal Reserve policy as trade tensions ripple through markets. Expectations are rising that the Fed may front-load rate cuts in response to economic uncertainty, especially given recent signs of a weakening U.S. labor market. This sentiment is reflected in falling short-term Treasury yields, signaling a market bracing for lower borrowing costs. Meanwhile, gold's surge toward record highs indicates that investors are flocking to tangible assets for safety, while riskier options like Bitcoin continue to decline. The interplay between geopolitical events, central bank policy, and investor psychology is creating an environment of heightened volatility, where every headline can sway market sentiment dramatically, making it a challenging landscape for both institutional and retail investors alike. Oil markets are also reflecting this cautious sentiment. Brent crude fell 1.7% to $62.63 per barrel, following an OPEC report indicating that global oil supply is expected to roughly match demand next year, in contrast to last month's projections of a shortfall. This shift removes one potential source of market volatility, but adds pressure to investors weighing energy sector positions. Meanwhile, global stock indices remain fragile. European shares dipped 0.7%, and technology stocks in Asia were notably weak. U.S. futures for the S&P 500 and Nasdaq signaled that Monday's rally may not hold, leaving traders uncertain about near-term direction. With trade tensions, central bank policy, and commodity markets all in flux, investors are navigating one of the most complex environments of the year. Looking ahead, attention will be squarely on the U.S.-China summit in late October. Markets are trying to price in the potential outcomes, balancing optimism for a durable trade deal with the risks of escalation. Safe haven assets like gold, the yen, and U.S. Treasuries are likely to remain attractive, while risk assets, including equities and cryptocurrencies, could see volatility spike with any major announcement. Traders and investors alike are bracing for rapid swings in sentiment, as even small statements from either government could trigger significant market moves. For now, the focus is on caution, hedging positions, and closely monitoring developments that could shape the global economic landscape for the remainder of the year.